Good morning, welcome to the Australian Early Finance Briefing for Tuesday, the 18th of August 2020. My name is Nick Hurley here in Melbourne. We're well into the Australian quarterly reporting season. We've had about 25% of large cap companies report so far, comprising of about 40% of the ASX market cap. And by the end of this week, that number will rise to 65% of the ASX 200. Interestingly, there's been a fairly positive beat to miss ratio, as UBS state. So there's been a lot more companies beating analysts' expectations than expected. Something people would generally be surprised at. It's probably an indication that analysts didn't really either factor in the positive impacts of the JobKeeper program and just overestimate the negative impacts of the pandemic. The revisions in guidance seem to be driving the share price the most significantly as a result of the results announcements, not so much whether they've missed or exceeded the current quarter. It seems like the market's really just more interested in what's happening further ahead in the future beyond the pandemic. And in fact, most companies actually have a slightly positive stock price reaction as a result of their announcements. What's been most surprising with this reporting season is probably the dividends. There was a lot of expectations in the market that there'd be huge cuts to dividends. Some companies have, like Bendigo, Adelaide Bank, but largely dividends have been left untouched or increased. So JP Morgan analysts have said in August, over half of the ASX companies that have reported have seen their dividend forecasts raised, whilst 30% have encountered downward revisions. Jason Steed says that this is in keeping with the trend of recent reporting seasons where revisions to dividend forecasts have been less negative than those to earnings. So there's definitely a real tradition in the Australian corporate space to keep paying out those dividends, keep the yield up, support the superannuation funds, and continue with the trend of under investing in capital and expansion. So some of the companies we've got reporting this week, we have BHP reporting today, including Cochlear, Coles and Westpac. Then later in the week, we have Boral, CSL, Crown, A2 Milk, WiseTech, Coca-Cola Amatil, Qantas, Santos, South 32, Webjet, Wesfarmers. So lots of big names reporting this week. An update on the vaccine. The AstraZeneca Oxford University vaccine, which is something we've mentioned a number of times on this program. CSL has announced yesterday that they are in talks with AstraZeneca about manufacturing the vaccine here in Melbourne, in Broadmeadows, in their CSL Bearings plant. It's set up for mammalian cell production or recombinant therapies, which means that they have the capabilities for the Oxford University vaccine. Now, CSL, interestingly, has got a new board member recently who is the chief executive of AstraZeneca, Pascal Soriot. So a useful pairing there. Also, they've mentioned that they're still prioritising the University of Queensland molecular clamp vaccine, but that's not going to be ready for a year. So that's really, comparing it to this AstraZeneca vaccine, it's basically a year behind. And certainly when the time's of the essence here, it's not really, it's decreasingly looking like it's going to be the one we need to rely on here in Australia. So we've also had the Federal Health Minister increase his sort of positive attitude towards a vaccine. On Sky News on the weekend, he said, "We are in advanced negotiations with a range of different companies with regards to a vaccine. I've been very cautious in the past about the prospect of a vaccine. I'm now, on the basis of best health advice, genuinely more optimistic." Just to follow that up, on Bloomberg TV earlier today, we had Chief Market Strategist at First Franklin mention that basically, if you're going to wait for the vaccine to be sort of confirmed, the market will have already moved. So he says If you can buy into that story, you need to be ahead of money flowing into these value and cyclical stocks. If you wait for a vaccine to come out, you're going to be missing probably the biggest opportunity right now. Staying in the US now, and on the topic of value stock, the world's most famous value investor, Warren Buffett, has sold all his banking stocks, or large parts of it. He's cut his Wells Fargo holding by 26%, his JP Morgan holding by 62%. He's also sold shares of BNY, M&T, and PNC Financials. That has also led to them being down a bit this morning in the US, but overall the banks have taken a big hit in the US, having to set aside tens of billions of dollars for potential loan losses. And a number of bank executives have said they believe the current recession will now be deeper and longer than initially expected. So the KBW Nasdaq Bank Index has fallen 31% this year. Staying in the US now, we've had an interesting month in the sub-investment grade debt markets, corporate debt markets in the US. The high yield market has already topped $44 billion in issuance. Typically August being the summer holiday month in the Northern Hemisphere, it's generally very quiet. So it's the biggest record ever. The previous high was 33 billion of issuance back in August 2012. It's a sign that the Federal Reserve's bond buying program is effective in its attempts to resuscitate credit markets in the wake of the pandemic. So since May, the Fed has amassed $8.7 trillion of ETF funds focused on investment grade and high yield bonds. Starting in mid-June, it has also purchased $3.6 billion of mostly investment-grade corporate bonds issued by companies including Walmart, Berkshire Hathaway, and Boeing. So interestingly, this junk bond buying spree seems to be continuing. Moving to the markets now, the US has opened up, led by NASDAQ. It's up about 75 basis points. We're seeing the S&P up about 30 basis points. The Australian dollar's back above 72 US cents. And beyond the long list of companies reporting today, we also have the Reserve Bank meeting minutes being released at 11:30 a.m. Have a great day and look forward to seeing you tomorrow.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.